So today we're going to be talking about a topic that is near and dear to my heart, and that's concentrated stock positions. So we work with a lot of business owners and a lot of executives, specifically from like the financial industry and even like some larger publicly traded companies that are operate in Northeastern Wisconsin that have some different incentive packages for employees and things like that. And a lot of them end up in a situation where they kind of have all their eggs in one basket. They have, whether it's one stock, or maybe they worked for 2 or 3 different employers in the same industry, and they end up with just 80% of their money in one industry, and they don't really feel like they have an escape plan. They don't have an exit strategy. And today we're going to share quite a few different ways how to exit that position and do so in a way that minimizes your taxes. You can keep more money in your pocket, which means, of course, more retirement income for you, more money potentially for inheritance, for heirs, or also your potential for more gifting. So more money for charities, nonprofits, organizations like that you want to gift assets to. There's a lot of great strategies in here. So let's get started. This commonly pops up. I already mentioned like executives or managers that have been with a company for 20 or 30 years, and this might be through a 401k that they're getting awarded company stock. But in a lot of cases too, it's somebody that just they work for a company that they think is an awesome company, and they just start buying the stock, and they take a certain percentage every month and start buying the stock. And 20, 30 years down the line, they end up with this big giant position in one company. And we also see it a lot in the tech world. Whether it's a brand new startup or even a bigger tech company, in many cases, they're awarding you options, they're awarding you restricted stock units, different things like that wind up in you with this massive single stock position. And then we also see this pop up in a situation that I just call runaway gains. So what I mean by that is someone throws a smaller amount, they throw $10,000 in a single stock or something, and it just goes gangbusters, and pretty soon they got 400 grand in there out of a $600,000 portfolio that's in this one thing that really took off. And that's not as frequent. Where we usually see it as executives and tech employees, but still, regardless of how you accumulated this position, the exit strategies are going to be similar. So it's going to be different depending on what account types they're in, whether it's like an IRA or a brokerage account or some sort of other like restricted stock package. But one second here, I just had a notification. All right, cool. So my question is, to begin with, is do you even need an exit strategy? And do you have one? So then the next slide is going to be, do you need one? This slide, though, is if you're in terms of exiting a single stock position, there's only really 2 options. Number one is you exit the position on your terms. There's a lot of ways to do that. We're going to talk about, you can sell it, you can hedge it, you can gift it. There's a bunch of different things you can do, but you can only ultimately control it or just delay it and procrastinate. And in that case, you're being very reactive. Okay. If you wait and say, hey, I'm going to just hold this position until I have to sell it, or until I'm forced to sell it, or maybe the market will crash and then I can sell it and not take as big of a tax hit. That's all reactive stuff. So if you know us, if you know Safeguard Wealth Management, you know that we're all about being proactive, and we're really all about you being in the driver's seat, you being in control, not only of your money, but like your taxes, your tax decisions. We don't want them being made by Congress out in DC. We want the tax decisions being made proactively by you, with our advice and some of our ideas. But ultimately, we believe that option number 1, exiting on your terms, is the only real option, and everything else is really dangerous. That's just how we look at things. So do you need an exit strategy? So let me start off with that. Number 1, is your entire retirement dependent upon the position? So as an example, if let's say you had $1 million saved for retirement and 999,000 of it was in one stock, obviously your retirement is dependent on that position. This assumes you don't have a pension. It's like if you can't live on Social Security, then your retirement is dependent on that one stock, which means you need an exit strategy, because we believe you should never take a risk of ruin. You should never in your investing career take a risk that if it goes wrong, you can't recover from it. We're a lot more conservative than a lot of planners in that regard, that will allow you to take a risk of ruin. I just think it's obviously something that you want to avoid. Number 2, is the position larger than 10% of your portfolio? Now, for some people, if you're in your 30s or 40s, the position's 10% of your portfolio, things about the company, you like the company, that's different. What I'm talking about is you're at retirement and say 10% of your net worth, 10% of your liquid portfolio is invested in one company, to us, that's pretty high. I mean, I prefer to see them under 5%. But what it ultimately comes down to is this third question: does the position keep you up at night? So if you're in a situation where, let's say you have $300,000 tied up in one stock, and you're only pulling, say, $50,000 a year for retirement income, what happens in retirement is you start to look at that one position like, man, this is 5 or 6 years of retirement income. If they miss earnings, I could lose 2 years of income. And I would say, if you're ever in a position with any investment you have, any type of asset, anything, if you're ever in a position where there's something that is financially related and you're thinking about it at night, that's a hint. That's a hint that you need to take action and do something about it, because all of these things, risk can be transferred. It can even be eliminated. You can hedge it. There's a lot of different things you can do. If it's keeping you up at night, life's too short. You didn't accumulate all of this money so that you could spend your retirement worrying about losing it. It's really about enjoying this money, enjoying the lifestyle, enjoying that money with experiences with kids, grandkids, gifting that money to causes you care about. It's not about being kept up at night. So if you answer yes to any of these questions, you need an exit strategy. So let's get into just ultra simplified. What are my options for an exit strategy? Number one, you can just exit. You can just sell it. Okay. That one, we'll go through a couple examples, but that one's pretty simple. Hurts a little bit on the tax side. Number two, you can hedge it. So what that means is you can reduce your risk in the position without taking the tax hit in the position. And we'll go through some examples of what that looks like. And then number three, you can gift it. So that's it. You can sell it, you can hedge it, you can gift it. To put even in more of like a analogy or metaphor, you have this risk. Okay. You can either just eliminate it, you can sell it, just eliminate that risk, or you can hedge the risk. You can transfer that risk to somebody else and just reduce it, or you can take that problem, this risk you have, and you can just give it to somebody else. And now it's their problem. And we'll go through how that can actually be beneficial to both people in just a minute. But first, we're going to start off with selling it. And first, we're actually going to start off with this example. So this is Bob. Bob worked for a bank for 30 years, and through some stock awards and option plans and different things, he's accumulated $2 million worth of one bank stock. Outside of this bank stock, he has $100,000 in a checking account. He has $400,000 in a 401k, like outside of the bank and of the bank stock. And then he has a home worth $500,000. So I obviously made this up, right? So these are just real clean round numbers. But in this situation, he has a net worth of $3 million. And out of that $3 million, 2/3 of it is in stock of one company. Okay. This is keeping him up at night. I can promise you he's worrying about it. No matter how confident he is in the company, it's in the back of his mind and he's thinking about it all the time. Okay, but just know that it's about 2/3 of his overall portfolio. This is definitely well beyond a concentrated stock portfolio or concentrated stock position. So is his retirement dependent on the position? I would say probably. It depends. If he can live on Social Security, or let's say his Social Security is $3,000 and he has $1,000 pension, so that's $4,000 a month of income. If he can live on $4,000 a month, then I would argue that his retirement might not actually be dependent on that position. Any additional income needs he has the 401k and things like that. But most likely for most people that have, this type of situation, yes, it's his retirement, the next 20, 30 years of his financial life is probably dependent on the performance of this bank. Okay. Is the position larger than 10% of his portfolio? Yeah, it's way bigger. It's like 66%, 67% of his portfolio. And does it keep him up at night? And what we'll hear a lot of times is, no, it doesn't keep me up at night. But in March it did, or in 2008 it did. And that's a hint. That's a hint that that's too big of a risk for your goals and for what you're trying to do. So he kind of checks all three boxes here. He needs to exit this position. So what are his options? Well, the reason a lot of times people come to us is they go, man, if I sell this stock, my cost base, it's worth 2 million, but my cost basis is only 200,000. So if I sell it right now, I'm going to have $1.8 million in gains, and that's going to be painful. I'll be the first to tell you, 1.8 million of gains. You're going to not only be in the top capital gains bracket, but it's going to mess up everything. It's going to jack up healthcare costs if you're on the Affordable Care Act. It's going to jack up Medicare costs due to IRMA, that income-based monthly adjustment amount, that IRMA. So I'm going to actually take a step back and say, pretend it's not in a brokerage account. If it had been in a 401k, if he has the $2 million of stock awarded to him through the form of like restricted stock units or different things like that, he has an option to elect what's called net unrealized appreciation. This should be used much more than it is, in my opinion. But what it basically ends up happening is, instead of having 1.8 million of IRA asset, he rolls instead of having 2 million of stock, instead of having 2 million in an IRA, he could roll it out to a brokerage account. He would only pay income tax on the original basis, the 200 grand, and then he would have long-term capital gains on the remainder. So why would you do that? Well, you're paying income on the first 200 grand, and then you're only paying capital gains rates on the remaining 1.8 million. So if it were in a 401k, you get a little bit of a loophole. You can do this net unrealized appreciation, roll it out, take an income tax hit only on the 200 grand and get a much more favorable treatment on the rest of it. But we run into a lot of these situations where it's not in a 401k. Okay. And it's someone that just accumulated this stock on their own, or, we've run into them a lot where it's a tech company and they just, not only were they getting the awards in their 401k, but they were also with their own personal money buying a bunch of the stock themselves in like a brokerage account. And the rough part here is, if he takes a $1.8 million hit there, if he sells the whole thing, he's going to get taxed at 20%, because that's the top capital gains bracket. He's going to pay 360 grand in taxes. So he's going to sell 2 million. He's going to pay 360 grand in taxes. So he's going to end up with 1.64 million that he's going to actually walk away with. But again, if he's on Obamacare, if he's on the Affordable Care Act health insurance, his subsidy is going to go away. Okay. He's going to have to pay a lot more there. And that's sort of up in the air right now due to the American Rescue Act. But throw that aside for now. In the vast majority of situations, that's going to affect his health insurance costs. It's also going to jack his Medicare up several $100s a month. It starts off at 144. It goes up from there. So the higher your income gets, the more you pay for Medicare. Also, the biggest thing in his situation is that's going to create a very rough taxation situation for his Social Security. Eric has done some videos on provisional income and on the Social Security tax trap and tax torpedo and all these different things. And just know that in this situation, if you all of a sudden show a much higher income, it's going to for most people, it's going to lead to Social Security being taxed at higher rates than it was before, which effectively means more taxes on this sale. So obviously, you don't want to just sell it, take the big hit up front, but you could do something like trimming. So we're going to sell $100,000 a year, and hey, I'm going to pay, if he was in the top bracket, he's going to pay 20 grand of taxes. Otherwise, if he was down in the next bracket, down for capital gains, he would only pay $15,000 of taxes. And it would also only increase his adjusted gross income by $80,000. It basically spreads out the impact. And this is the route a lot of people try to go. The problem is it takes time, and it's obviously expensive from a tax standpoint. So here's some of the more advanced options. So when we get into hedging, this is a situation where you go out and buy a put option on the stock. So let's say the stock is trading here at $50. You go out and buy a put option at $40, so that if that stock crashes, if it goes all the way down to zero, you get $40 a share on that position. So what you basically did is you took a lot of the market risk out of it. You took 80% of the single stock risk out of it, but you don't take any tax impact right now. So that's an interesting option. But the problem is you got to buy that put option, and that insurance right now is a little bit cheaper because, people, as they get more optimistic about the market and as things are rising, these insurance like put options tend to look a little bit cheaper and things like that. But let's say Bob doesn't want to buy the put option. He doesn't want to pay a certain amount of money just to have that insurance. This is where you get into the most common way that executives and billionaires hedge a position. So Mark Cuban was famous for this because he hedged his Yahoo position. He had a blog. He sold that blog to Yahoo. They gave him stock. The reason that they gave him stock in Yahoo is because the company Yahoo thought their own stock was overvalued. So they went like, man, we can give him $1 billion of cash, or we can give him $1 billion of stock that we think is only worth 500 million. So they gave him this giant stock position. He went out and called in immediately. This is basically, I would say this was probably the most important thing Mark Cuban did in his investment career. He immediately collared the position. So what that means is he went out, he sold a call option took the proceeds, took the cash that he made selling that call option, and he bought a put option. And what this means, just in summary, is he set a collar where let's say they give him the stock and it's at $40. He sells a call at 45, he buys a put at 35, and he basically locks in that if it's in that range, he's going to get whatever price the stock's at. If it goes above that, he's limited at that call. He's limited to the $45. If it crashes, which it did, then he gets the bottom end of that range and he doesn't have to pay for the insurance, because the call option he basically sells some upside to protect a bunch of downside. This is very common collaring of a stock position. So here's the deal, though. You talk with guys like this that have built up a several $1 million position in one individual stock. They tend to not want to bet against that company. This company's made them a bunch of money. They still believe in the company. They don't want to bet against the bank. This is where you get even more advanced and you start to say, okay, there's another way we can hedge it. We can short other banks. So what that means is we can bet against other banks. So here's a situation where this last month, here's two different companies in the same industry, and the kind of lighter blue line, they both traded up early. They were both up 20 and 30% in the first few weeks of the month, but then they both crashed in the latter part of the month. So from March 22 to March 29th, they went from 20 and 30% up on the year to down 40% in the month. So that's like a 50% swing, 60% swing. And what you'll notice here is if he had $2 million bet on his bank, let's say his bank is the dark blue line, and then he had some amount of money, it could be 2 million, but it's totally flexible, that he's short another bank or a whole bunch of banks, the light blue line. In this situation, even though the stock, so his dark blue line lost a bunch of money, right? But because the other portfolio, all the other banks that he was betting against, because those lost more money, in this scenario, he would actually make money. So even though he finishes the month, he's down 30%, the stock price is down 30%. His companies that he were betting against were down more than that. So in this scenario, it's all about relative performance. If he was short a bunch of other banks he didn't like, and he was betting on his bank, then he would make money in this scenario. I don't recommend pairs trading, because as you can see from the beginning of the month here, from like the beginning of March up through March 15th, he would have been down on the position because his bank was not doing as well when things were going up there early in the month. So the more conversations we have with these individuals, sometimes we'll get into a situation like this where we go through all the hedging examples, we go through the collaring examples, and eventually it gets down to a point where they just go, look, Tony, I don't care if I get any of this. With just my Social Security and my 401k, I'm going to be okay. We have no debt. I've been everywhere I want to go. I can get by on $4,500 a month, which between my Social Security and my pension and a small withdrawal on my 401k, I'm totally fine. So that, this money is mainly for my kids or mainly for my charity. So in this first example, we're just going to go through kids. So this is very powerful. This particular, out of all the options we're going to go through, this I would say is the most frequently utilized option. And it goes like this. If Bob gifts his stock to his children or grandchildren, they will only pay capital gains on the portion they sell and at their own brackets. So on the right here, I have the capital gains brackets. So let's say that I gift stock to my son, and my son makes $70,000 a year. So let's say my son is married, so he's in this right bracket here. I gift him stock. He makes $70,000 a year. And we'll say after deductions, we'll just say $10,000. So his taxable income is $60,000. He could take $20,000 of gains here to get up to that 80 grand and not pay any capital gains on it. So we see this a lot when it's in an inheritance situation where this money is going to kids, grandkids, stuff like that. Think about your grandkids. I mean, you look over here on the left, a single individual, they can have up to 40 grand in capital gains and not pay capital gains tax. Okay. So if you have 7 grandkids, that's 280 grand worth of capital gains each year that you can take and not pay taxes on. So you would obviously only want to do that if the money is going to them or you really don't think you need it. But I think it's a very, very powerful strategy when you start to look at, hey, if you really want to get out of this without capital gains, if the money's going to them at some point anyway, why not do it now? It's also cool. Like, this could be used for college funding. This could be used, if you give me 100 grand when I'm 50 years old, or you give me 5 or 10 grand when I'm going into college, that actually has more impact in a lot of cases. So you get them that money earlier, you do it in a much more tax efficient way. The only loser here is the government, right? Because they're losing out on capital gains taxes. So the other option here is if this money is ending up going to a charity, he can gift the stock to charity and there's just no capital gains. So he takes that $2 million position. He could spread it out between some grandkids and even take another $500,000 or something, give it to a charity. You don't pay any capital gains, neither does the charity. Okay, so that's pretty interesting. More advanced. This one is, I would say, the most utilized. Like, this is the most common way that people do this in the gifting world, but it's also a little bit complicated. So bear with me while I get through it. So there's something called a donor-advised fund. Think about it as this is a pool. The donor-advised fund is a pool that gives money to charities. Okay. This pool is separate from you. So like, I'm here, I got my $2 million stock. My donor-advised fund is a separate entity over here. If I gift my $2 million into this donor-advised fund, I don't have to pay taxes. So I can deduct the contribution in the year that I give the stock. Even if this other entity, this donor advised fund, it might not actually give the cash to a charity for years and years and years. And that's okay. As long as it's in a donor advised fund that says this money is eventually going to a 501c3, that's okay. So if you give it straight up, give it to the private foundation. So like, let's say that the Red Cross or something, let's say they have a donor advised fund. If you give it to them, then you can deduct up to 30% of your adjusted gross income. If you do it into your own donor advised fund, then you can only deduct 20% of your income. What's really cool about this is a lot of people right now, with how high the standard deduction is, they're just taking the standard deduction. Where if they did some of these gifts, let's say they go, oh, I want to give 50 grand a year for the next 10 years to this charity. You could just do the whole $500,000 chunk into a donor advised fund, get a massive deduction this year, maybe use that big deduction to do some conversions or there's a lot of tax planning that can go into this because you batched 10 years of gifting onto one tax return, okay, in 1 year. So it's pretty powerful. That's the donor advised fund stuff we see all the time. The last option, a little bit more advanced, we help people with these from time to time, but it's called a charitable remainder trust. And the way a charitable remainder trust is, let's say you own stock in a railroad, and that railroad pays out a dividend. And we'll just, to make the math easy, we'll say it pays out a 5% dividend. So you got $1 million. We're starting over here in the top left where it says the individual. They take that $1 million and they put it into the charitable remainder trust. Okay, so now that trust owns $1 million. But what's interesting is, as it's paying out 50 grand a year in dividends, you and your heirs can actually receive that income stream. So you and your beneficiaries receive that dividend payment. In a bond, it can be the interest payment. There's a special dividend. You can get that too. But that income stream comes back to you while you're alive. But then when you pass away, it goes on to those charities. And this is a very, very interesting way to essentially get a lot of the benefits of the stock ownership without the negative tax impact and without having to take a big hit right now in terms of capital gains and stuff like that. So as usual, as wrapping this up, we have this nice hammock on the beach here. You don't need more money. You need a better plan. All of our planning, as you've probably learned by now, revolves around tax efficiency, fee savings, and just in general being more efficient, getting your dollars working harder, paying out less in fees, paying out less in taxes. And this is a prime example. If you have a situation where you're being kept up at night by a large position, you have more options. This is not just sell it, bite the bullet, pay a bunch of taxes, or let it ride and take all the market risk. You have a lot of options. You could do charitable remainder trust. You could do, gifting, where you just give the stock to kids. There's a million different things you can do. And these aren't even all the options. So the stuff we just went through, this is kind of the basic way where you can buy a put option, you can collar it, you can gift it, this is the basic kind of 101 version of exiting concentrated stock positions. There's a whole nother layer that comes into this when we get into the legacy side and the estate planning side that would really turn into like a whole 3-hour class. And I would just say, if you have any questions about any of this type of stuff, you don't even need to, you can feel free to comment down below in this video and just say, hey, I'd like to chat or whatever. But also you can shoot me an email, Tony@safeguardinvest.com. You can shoot Eric an email, Eric@safeguardinvest.com. You can call our number here at the office, 920-544-0576, because you have a lot of options. The toolbox is full. There's 15, 20, 30 different ways to deal with a concentrated stock position. Don't feel like you're trapped, because you're not. And this is Tony from Safeguard, just reminding you here at the end of this, you don't need more money. You need a better plan. Thanks so much for watching. Thanks for being a part of the Retirement Mastery Group. Please like this video, comment on it. If you have any questions, jump in and comment. I'm going to check for any questions here real quick. All I see is that you can see me comment, which is good. And I appreciate all you guys in the group. And thanks so much for watching. And we'll talk again soon. Take care.